Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial jargon and find the juicy bits buried in corporate filings. Today we're diving into Kindcard, Incorporated's latest quarterly report, and let's just say their balance sheet looks like a bit of a roller coaster. So, what's the big story with Kindcard this quarter? Well, they're in the fintech and paytech space, offering payment solutions. But when we look at their numbers, it feels like they're really battling to keep their head above water. This report covers the period ending the 31st of October, 2025, and it's packed with the usual financial statements that can make your eyes glaze over. But we're going to break down the key takeaways, and trust me, there are some eye-opening figures here. If you enjoy uncovering the real story behind the numbers, make sure you hit that subscribe button. And hey, we have a growing community on Discord where we chat about these filings daily, so check out the link in the description below. Let's start with the balance sheet. This is like a snapshot of what the company owns and owes at a specific point in time. On the 31st of October 2025, Kindcard had total assets of about $47,046. Now, that might sound small, but compare that to the 31st of January 2025, when their assets were a much higher $86,018. That's a significant drop. On the other side of the coin, their liabilities tell a concerning story. As of the 31st of October 2025, their total current liabilities were over $1 million, specifically $1,083,786. And looking back to the 31st of January 2025, it was $973,174. So, while their assets are shrinking, their short-term debts are growing. That is not a good sign for short-term financial health. And then to raise the accumulated deficit, which is basically the total net losses the company has incurred over its lifetime. As of the 31st of October 2025, this number was a whopping negative $1,700,559. That means they've lost a lot more money than they've ever made. This figure grew from about negative $142,234 at the beginning of the year. This is a major red flag for any company. Now, let's look at how they've been performing in terms of making money. The statement of operations shows their revenues and expenses. For the 3 months ending the 31st of October 2025, their total revenue was $97,711. That's down from $139,366 in the same period a year earlier. Looking at the 9-month period, the picture is similar. Revenues were $274,232 compared to $301,159 for the same period in 2024. So across the board, their revenue is declining. This means fewer customers or lower spending per customer. This revenue drop directly impacts their gross profit, which is what's left after they pay to produce their goods or services. For the 3 months, gross profit fell from $114,104 to $63,838. And for the 9 months, it dropped from $240,563 to $201,659. Less profit means less money to cover essential operating costs. And the bottom line is a net loss. The 3-month period ended the 31st of October 2025, shows a net loss of $44,881. This is actually better than the loss of $7,588 in the previous year's comparable period, but it's still a loss. For the 9 months, the net loss widened significantly from $181,175 to $278,425. This means they're losing money faster over the longer term. Let's talk about their stock. The authorized number of common shares is 200 million, and as of the 31st of October 2025, they had 103,330,799 shares issued and outstanding. This number increased from just over 98 million at the start of the year, mainly due to issuing shares for services. Their additional paid-in capital, which is the money investors paid above the par value of the stock, has increased. It went from $277,471 to $401,330. This rise is mainly from those shares issued for services, which highlights that they're not necessarily getting cash injections, but are using stock to pay for things. The statement of stockholders' deficit really lays bare the company's financial struggles. As we saw with the accumulated deficit, this section reflects their negative overall equity. It's a stark reminder of how much more money they've lost than they've managed to earn and reinvest. By the 31st of October 2025, the total stockholders' deficit stood at a negative $1,195,898. This means their liabilities far outweigh their assets, leaving them in a deficit position. One notable transaction from the first half of 2025 was the issuance of over 5 million shares for consulting services, leading to a significant jump in additional paid-in capital, but also a substantial increase in the number of outstanding shares without a corresponding cash inflow. That's like paying your bills with IOUS instead of actual money. The cash flow statement tells us where the money is coming from and going. For the 9 months ended the 31st of October 2025, the company used a net of $47,730 in operating activities. This is better than the $92,224 used in the same period in 2024, but that is mainly due to some accounting adjustments and changes in how they manage their working capital. Financing activities show how they are raising money. In the 9 months ending the 31st of October 2025, they had net cash provided by financing activities of $48,339. This came from proceeds from notes payable, but also a significant repayment of related party loans. The overall result is that their cash balance at the end of the period was just $9,698. This is a tiny amount of cash for any operating business, especially one that is trying to grow. It was slightly up from $9,089 at the beginning of the period, but it's an incredibly precarious cash position. Digging into the notes, we find out that Kindcard Inc. provides payment solutions through its subsidiaries Deb Inc. and Tendercard Inc. They believe mobile wallet technology is the future, and they aim to capture market share. This section is crucial. The report explicitly states, and I quote, "The company will require additional funding to meet its ongoing obligations and to fund anticipated operating losses." The ability of the company to continue as a going concern is dependent on raising capital to fund its business plan and ultimately to attain profitable operations. This means there is substantial doubt about whether the company can survive for the next year without significant new funding. This is the biggest warning sign in the entire report. Looking at their assets again, they have an item called unbilled revenue net. As of the 31st of October 2025, this was $3,554. This represents revenue they've earned but haven't yet billed to customers. It's a small amount and it's down from $17,000 at the start of the year. Their intangible assets, which include things like technology and brand names, have also significantly decreased from $39,964 to $13,194. This often means they've either amortized those assets over time or written down their value, indicating a potential loss in their value or a reduction in their expected future benefit. Back to liabilities, their accounts payable, what they owe to suppliers, stands at a substantial $330,261. This is a significant chunk of their short-term obligations. This is where things get interesting. A significant portion of their debt is owed to related parties, primarily RM Management Group LLC, which is owned by their CEO, Michael Rosen. As of the 31st of October 2025, the total due to related parties was $318,900. This includes several promissory notes and loans with varying interest rates and maturity dates, some of which have been extended. While related party transactions aren't always bad, the sheer amount here, coupled with the company's precarious financial state, warrants attention. It raises questions about where the company's priorities lie. They also have a small business administration loan, which is a long-term liability of $150,000. While this is a standard form of financing, it adds to their overall debt burden. In their commitments and contingencies, they mention a past advisory agreement where they agreed to pay fees and issue stock. The good news is, as of the 10th of December 2025, the advisor waived outstanding fees and the agreement was terminated, so that potential obligation is gone. However, it shows the kind of agreements they've been entering into in their quest for growth. This note details their common stock. They issued over 5 million shares to a consultant in June 2025 for services. This increased their outstanding share count quite a bit. Remember, when a company issues a lot of stock for no cash, it can dilute the value of existing shares. In the management's discussion and analysis section, they talk about their plans and strategies, focusing on their fintech and paytech offerings. They reiterate their belief in mobile wallet technology and their goal to grow their user base. However, the financial reality presented in the statements paints a much tougher picture than their optimistic outlook. This section is where they directly address their ability to keep operating. They openly admit they anticipate requiring additional financing and that their current funds are not sufficient. They mention owing their CEO over $325,000 personally through various arrangements. It's clear they are heavily reliant on external funding and the CEO's personal financial support to stay afloat. This part is about their internal controls. They admit that their disclosure controls and procedures were not effective due to material weaknesses in their internal controls over financial reporting. This is another significant red flag, as it suggests potential issues with how they manage their financial information and ensure its accuracy. Let's put on our Warren Buffett hat and analyze what this all means. Kindcard Inc. is in a very tough spot. Their revenues are declining, they are consistently losing money, and their accumulated deficit is substantial. The fact that they have such a small amount of cash on hand and significant liabilities, including a large amount owed to related parties, points to a severe liquidity crisis. The explicit mention of substantial doubt about their ability to continue as a going concern is the most critical takeaway here. This means they are on the brink and need a miracle in the form of significant investment to survive. The issuance of stock for services, while it might look good on paper in terms of raising capital, doesn't bring in much needed cash. It just increases the number of shares outstanding, potentially diluting existing shareholders. The fact that their debt is largely tied to related parties, especially their CEO, raises governance concerns and could indicate a lack of external financing options. Their strategy of focusing on mobile wallets and payment solutions is a sound one in theory, but execution and financial management seem to be major stumbling blocks. They need to not only grow their revenue, but also become profitable and manage their expenses much more effectively. The material weaknesses in their internal controls add another layer of concern about the reliability of their financial reporting. The big opportunity for Kindcard would be a major capital infusion from a strategic investor who believes in their technology and long-term vision, alongside a complete overhaul of their financial management and operational efficiency. Without that, the risks are simply too high. In conclusion, Kindcard Incorporated is facing significant financial headwinds. Their declining revenues, persistent losses, low cash reserves, and reliance on related party financing paint a picture of a company in distress. Unless they can secure substantial new funding and demonstrate a clear path to profitability, their future as a going concern is very much in doubt. Alright, that is our deep dive into Kindcard's latest quarterly report. What do you think about their financial situation and their chances of survival? Drop your thoughts in the comments below. If you found this analysis useful, please give it a thumbs up and don't forget to subscribe for more. And once again, don't forget to join our Discord community, linked in the description. Thanks for watching and we'll see you in the next one.